So just welcome everyone today. My name is Claire Ladd. I'm the Programs and Services Manager at the Massachusetts Nonprofit Network. And thank you so much for joining us today. A few super quick items before we get into it. The recording and the slides from today's program will be emailed to you following the webinar, so just keep an eye out for that. If you can submit questions during the webinar via the chat or the Q&A function at any time as well, and we'll make sure to leave time for answering any questions. And if you have any technical difficulties during the webinar, you can just let us know during the chat as well, or anything else that comes up. I also want to give a little bit of background about us here at MNN. Our three goals are to strengthen the nonprofit sector through advocacy, public awareness, and capacity building services. So we offer this webinar as part of our series of webinars with our affiliate members. Please stay tuned for future webinars and let us know if there's any topics you'd like to see. And our efforts are made possible by our more than 600 member organizations. So thank you to all of you who are members. And if you have not yet joined, you can visit massnonprofitnet.org/join to find out more about all the benefits of membership. So for today's webinar, it's titled Gift Acceptance Policies, When, Why, and How to Look a Gift Horse in the Mouth. This presentation is brought to us by Hemenway and Barnes, and our presenters today are Eleanor Evans and Brad Bedingfield. I'll now hand it over to our presenters to get started.
Great. Hi, everybody, and welcome. We're glad to have you on today's webinar. I'm Eleanor Evans and joined by my partner, Brad Bedingfield, and we're both in the nonprofit practice here at Hemenway and Barnes, which is a proud sponsor of the Mass Nonprofit Network and its work with nonprofits across the Commonwealth. Brad and I represent a wide range of nonprofits, including colleges, universities, and other educational organizations, healthcare, human services organizations, museums, libraries, advocacy organizations, all different types. And while we do focus on a wide range of areas with our nonprofit clients, we do particularly focus on issues of development and planned giving, including advising nonprofits on negotiating, accepting, and administering complex charitable gifts, and on administering endowments and restricted funds, some of which we'll be touching on today. So we're going to look at issues that we flagged in our description. We're going to provide an overview of gift acceptance policies, what they are, why they're important, how to develop or update your organization's policy, how to implement them, and what issues policies should address. Our slides are to make sure that everybody's on the same page, but we know that many of you have had experience with gift acceptance policies and negotiating and administering complex gifts and may have specific questions on issues you'd like to be addressed. So do please chime in the chat and or Q&A sections. And we'll do our best to answer them as we go. If we don't have a chance or are not able to answer your question, do feel free to contact us afterwards, and our contact info is on the last slide. So first up, what is a gift acceptance policy exactly? At a high level, a gift acceptance policy sets out guidelines for the organization, its staff, board, and as well as donors and donor advisors to follow in soliciting, accepting, and managing charitable donations to the organization. And in the case of donors, in thinking about what gifts they would like to make and how they would like to make them. While not required by law, a gift acceptance policy helps the board fulfill its fiduciary duty to be an effective steward of the organization's assets and to make sure that they are being used in furtherance of the organization's charitable mission. And pretty much more than any other type of policy we draft for our clients, or we work with our clients in drafting, a gift acceptance policy needs to be customized to reflect and incorporate factors specific to the organization, such as its mission, its governance structure, its operations, donor base, and ability to accept various types of complex gifts. So we'll touch on some key aspects and components of gift acceptance policies a bit later in the presentation. But I just want to note that in addition to, or as part of a policy, including those key elements, organizations may also have procedures on how to administer gifts, including acknowledging, crediting, valuing, et cetera, gifts. Some organizations, if they get really detailed on those issues, or if those issues are internally focused, will carve those out and put them in a separate set of procedures that their staff can use along with the gift acceptance policy. And just in drafting the policy, you just want to be cognizant that one of the audiences for the policy is donors and donor advisors. So you don't necessarily want to load it up with all sorts of detailed operational issues that might confuse donors.
Yeah, and just to underscore that, Eleanor, as you mentioned, of all the kinds of documents that we work with in the Plan Giving world, I think the gift acceptance policies probably vary the most from organization to organization, and that's partly a function of the different kinds of things that people put in this policy, and we're going to talk more later about the kinds of things that you generally see. And how it's structured. It's sometimes one document, which could be 5 pages and could be 100 pages, or it's sometimes a series of documents that collectively are the gift acceptance policy. But there's no right answer there in terms of the form of it and how it's going to operate. But there are some commonalities in terms of its usefulness and its function. So let's talk a little bit about why you would want to have a gift acceptance policy. And just to highlight that with a couple of examples of situations where it was very useful to have had a gift acceptance policy for some folks that we've worked with in the past. Sometimes it's as simple as sussing out things like mission alignment and cost benefit analysis. I'm aware of one situation involving a gift to an organization that was putting on performances of music from a particular era, and somebody wanted to leave a significant gift to them to have them perform with respect to an artist from a different era, but that was close in time, like maybe 50 years after the period that they normally work with. And for someone like me who doesn't know anything about this, I would have thought, well, that's a wonderful gift. But having a gift acceptance policy whereby it's not just sort of the development person who's talking with someone and excited about the gift, but there's a process and a group of people reviewing different elements of this potential gift. They figured out that the cost of them to be able to perform this particular artist's work, because it required different instruments and a different style of music than what they normally did, would probably be more than the money that they would be giving. And it would involve a decision to expand their charitable purposes beyond what they typically did, which is a decision that really the board ought to be making if it comes to that. So it's just one example where having a gift acceptance policy helped avoid taking in a gift that they then might not have been able to deploy in the way that everybody intended. One example that I always think about when I'm talking about this topic involves restrictions on use of property. This involved somebody wanted to make a gift of their residence when they passed away to a university. And the university development folks got excited about that and thought, this is great. It's only a few blocks away from the university. We can use it for visiting professors. We can use it for study abroad students. We can use it for educational purposes, et cetera. And then the more into the conversation everybody got, the more clear it became that the donor here wanted the university to agree to essentially keep the house as a museum to that donor. So the donor had his initials all over the place, inside and outside the house. He wanted all the rooms to stay the way they were whenever he died. And it became clear that it was not something that the university was going to be able to use effectively. But it's the sort of thing that if you don't have a policy and you don't take the conversation to a certain point and get involved with the right people in the organization to make a decision like that, you could bring in something that looks really nice at the beginning, but turns out to be something of a white elephant. And the last one I'll mention involves gifts of interest in private company stock. And many of the things we'll talk about with the gift acceptance policy involve particular procedures for how to vet certain kinds of assets that might be coming in. And in this case, the private company stock is something that a charity can take in. But the development folks were very excited because it could have been a significant gift. And then it went to other people in the organization as part of the policy requirements, who dug deeper into the company and realized that this company was involved in internet porn. And they thought, well, do we really want to be the stockholders of something like that and have that on air? It was kind of embedded down in the organization, but it was enough that there was a risk element to this and a reputational element to this. Do we really want to take this in, knowing that we can't sell it readily because it's private company stock, and it may reflect on our reputation in a way that's contrary to our charitable mission? So those are a few examples where having the gift acceptance policy serves the function of requiring a larger group of people to look at something and apply a sort of groupthink analysis to it, where you might otherwise be making a mistake. So some reasons in the next slide as to why you might have one. Gift acceptance policies serve multiple uses. One of them is the one that I just mentioned, having a policy to ensure that you look at gifts in a way that allows everybody to get comfortable that this gift is really going to further our mission, that there's not going to be a sort of cost-benefit offset that makes it not worth taking in the gift. Just having a procedure itself is a useful thing so that everybody is doing things consistently. There's also an educational function to a gift acceptance policy, both internally and externally. Gift acceptance policies often include discussions of the types of things that somebody might give, which can be a fundraising tool, in that it can, if it's shared with your board of directors, as it usually is, as you're getting them to approve it, give them ideas for, these are the kinds of gifts that you folks should be making, planned gifts and the like. And similarly, externally, to the extent it's shared externally. And internally, it can be a good training manual for folks to understand the kinds of gifts, the kinds of things that they need that would raise red flags. And help clarify everybody's roles, help mitigate risks, and help vet gift restrictions like the ones around this house with the guy's initials everywhere, before you make a mistake and take it in and then have to find a way to remediate that.
So the process of developing and approving the policy is how you can make sure that the policy is going to work specifically for your organization and its needs, and also achieve the objectives that Brad just discussed. So, I mean, as we've talked about, it's critical to customize it for your organization. It should be fairly high level and provide a roadmap for staff, the board, and donors and their advisors to follow, rather than trying to address every possible situation that could come up. And as Brad mentioned, a key element of it is just focusing on sort of key principles and key processes that we go through to accept gifts, and when we will and won't accept certain gifts. While one person should probably be designated as the point person to wordsmith the policy and move it forward through the process, it is a collaborative process, as Brad mentioned. Both the development and updating and as well as the implementation of the policy is a collaborative process. So, and will of course affect various parts of the organization. So it's a good idea to get input from various stakeholders, including, of course, the development team, but also the finance team, the chief executive, and a board committee, such as the development or governance committee. And then many organizations have council review their policy before they send it to the board for its approval, just to make sure that it's consistent with applicable law and also isn't tying the organization's hands in a way that it wouldn't want to be. And then after the policy's been approved, it's important to revisit it regularly and to schedule that. So some policies even include, say that the policy will be reviewed every year, every 3 years. And because that process gives the folks involved in implementing the policy a chance to look and see how has implementation gone over the last year or 3 years, and have there been any changes in the law, or changes in our operations, or changes in our donor base, or changes in the types of giving that would warrant us making further changes to our policy. since
Yeah, and I'll just say that there are also larger trends and changes, and we're going to talk about some of them in terms of how organizations look at some of these issues, things like morality clauses and naming rights, where 20 years ago people looked at that and approached it, and your policies may have approached it differently than people generally do today. And so reviewing this periodically, consulting with outside counsel, working with board members who are on other nonprofit boards is a good way to have some sense of what other organizations are doing so that you're not too out of line with them. Because if you're too out of line with them, you may find yourself at a fundraising disadvantage compared to them, or you may find yourself taking on more risk than the general industry standard is at the moment.
All right, let's take a look at what some of the key issues your policy should address are. So as I mentioned, that it's critical that the policy, help the organization determine whether gifts are furthering its mission. So it's a good idea to include a copy of the mission statement at the beginning of the policy so that everybody can be on the same page about what that is. And then when reviewing particular gifts, the development team can revisit that mission, and also when discussing the policy with donors can point to that mission statement and say, this is our mission. And so compare your gift to our mission and work with them to help them understand why their gift might or might not work, or how we can maybe tweak some of the restrictions that you're proposing to be more in line with our mission. It's also a good idea to include a general statement about the purpose of the policy. We've given some language here on the slide, but the idea is just so that everybody's on the same page about what we're trying to do with this policy. And
Yeah.
then go ahead.
Yeah, I'll just say, yeah, and that's partly, internal training focus so that everybody knows why we're doing this. But there's a donor facing element to this as well, by, to the extent that the policy is shared with donors, and it should be, or there should be a version of it that is, then, this helps the donors understand that this policy doesn't exist to make things difficult for them, to create friction for them. It's there because this is important to the best interests of the organization. It's part of your fiduciary duties to make sure that you've got these kinds of screens in place. And donors generally understand that, especially if they're working with an organization that they know and trust.
And then you'll also want to put some information about the scope of the policy. So does it apply to all charitable gifts to the organization, or is there a subset of gifts that are carved out and are perhaps covered by a different policy? So a museum, for example, might have one general gift policy that applies to most gifts to the organization, but then gifts intended for the organization's collections might be covered in a separate collections policy that addresses acquisition and deacquisition of items in the collection. And then, of course, there should be a process for the review of gifts. Normally, the development team would do so in the first instance. And then if a gift is complex, for example, either due to the type of asset or the type of gift arrangement or the type or specific restrictions that a donor wants to place on the gift, then the development team might escalate that to a higher authority, which could be the chief executive, or it could be a gift review committee. And such a committee should be specified in the policy. So who's on the committee, designated by titles, and then the circumstances in which the committee would review gifts, and also the committee's authority. So for example, is it making the final decision, or is it making a recommendation for the CEO, for example, or to send back to development or to the board itself? And the policy should also state who with the organization is authorized to accept gifts on its behalf. Routine gifts, might be accepted by the director of development or the CEO. You might have other procedures for more complex gifts. And some organizations address these roles and responsibilities by having a roles and responsibilities section of their policy where they walk through the roles of the board, the CEO, the treasurer and CFO, the development director, et cetera, and the gift advisory committee as well. And then key factors to consider in reviewing gifts. I mean, a lot of these are just basic common sense, but as we've been talking about, sort of the overarching one is the gift's compatibility with the organization's mission and to some extent its values as well. And especially for restricted gifts, it's important to analyze whether the organization can use it in the way the donor intends. And Brad's examples, give some, some meat there. Obviously the university, was having trouble determining how it could accept the donor's house with his initials all over the place and, exactly as he left it. But it's also, important to look at other types of restrictions. So for example, you may have heard of the Pearson case involving the University of Chicago, where the university received a pledge of $100 million for a policy institute, and the donors made about 22 million or so, paid that amount on the pledge. But then the agreement with the donors for the institute was exceedingly detailed and very specific about exactly milestones and timeframes and what the criteria would be for the head of the institute. And I can't even get into all the detail here about what was involved. And needless to say, that led to contention, and then the donors sued to get their 22 million back, and didn't pay the rest of the pledge, and it's still in litigation. And so even if the university were to win, it still had to expend a lot of money to enforce its position. So really it's important to look at what is the donor intent and our planned use, and also would accepting this incur substantial expense or difficulty, and could it even lead to legal jeopardy down the line.
Yeah, and that's important because, generally speaking, the default rule is that if you don't, align your planned use with the donor intent up front before you receive the gift, then you're bound by the purpose restrictions in the surrounding the gift, unless the donor later releases them, or if the donor refuses to, or is unable to because he's passed away, for example, then you have to go to court generally to get permission to allow for that. So the more that can be carefully and thoughtfully baked into the process up front, the fewer headaches you're going to have later on.
And also this last point here about the primary benefit is to the organization and its beneficiaries rather than the donor, is that is grounded in the principle that charities, 501c3 organizations have to benefit the public in a wide charitable class, and can't provide more than an incidental benefit to private individuals or entities that are not in furtherance of its exempt purposes. So if a donor wants to make a gift and get something in return that the organization wouldn't normally provide, or that would be really outside the scope of what would be in furtherance of its mission, you want to look at that. So for example, if a donor wants to pay the organization money to do some proprietary research for the donor, that is not really consistent with it benefiting a general charitable class. And so that could, jeopardize in extreme circumstances, the organization's C3 status, and certainly doing so could cause the gift itself to not be deductible as well.
Great. So let's talk about turning down gifts. This poor sad person I'm imagining is a development professional who has been in conversation with a donor and now has to say no to that donor, and that's never a pleasant thing to do. But one of the key benefits of having a policy and a set of procedures like this is that it gives that hardworking development professional some cover in saying no, that they're not saying no, it's not a personal thing, it's a matter of the policy and the procedures. It's not going to take the sting out of it necessarily entirely, but it makes it more of an institutional decision than an individual point of friction. Now, to what extent is this addressed in the policy? Well, of course, an institution can always turn down gifts. You don't have to say that in the policy for that to be true, but it can be useful to say that in the policy, both so that you, again, have that internal training in terms of when would we refuse a gift, under what circumstances, under what principles, and that donor-facing element to signal early on in the conversation when you're sharing with them your gift acceptance policy that refusal is a possible answer here, and that these are the reasons why. And this is some language that we use in our gift acceptance policies. This differs for different organizations, or this is just an example that the organization may refuse gifts that are inconsistent with its mission or that are otherwise deemed by the body of people, the collective group, not to be in the organization's best interests, including, for example, because of restrictions or terms required by a prospective donor that they deem to be unduly burdensome or restrictive or inconsistent with the organization's charitable mission. And this is squishy language, and it's necessarily squishy because there is no gift acceptance policy that exists in the world that has a clear list of what we will take and what we will not take and under what conditions. One, such a thing would be volumes wide, and two, it would be both over-inclusive and under-inclusive in practice when you actually apply it. So the best you can really do is set forth principles like that to make people think about it. You know, is this really about our mission? Is this really about our best interests, as opposed to the donor wanting to use us to create a museum for himself, for example, with his personal house? And to front this conversation, you know, relatively early and in a nice way with donors, that might be an outcome here. So some examples on the next slide of situations in which gifts might not be accepted. And these are things that we sometimes list in the gift acceptance policy. Again, it's not an entirely inclusive list. It's a set of examples just to illustrate the kinds of things that folks should be looking out for. Property that appears to have been acquired illegally. You don't want to be whitewashing Bernie Madoff's reputation. Gifts that are restricted to a purpose that's inconsistent with what we do. The example I gave of the early music organization that was potentially going to get a gift that was a little outside their comfort zone. Another example that I've dealt with involved a gift to promote homeopathic medicine to a medical organization that did not believe in this aspect of homeopathic medicine. You know, that is a gift that maybe somebody could use appropriately, but it wasn't this particular organization, and that's the place for that to be sussed out. Gifts that would jeopardize your charitable status under 501c3. This could be because there's some impermissible private benefit involved. Maybe there's debt that's being relieved by them that they're dumping on you that you won't see until you really kind of dig down into it. Maybe it's because you're receiving something that is commercial in nature and is going to generate a lot of unrelated business taxable income, which could be problematic for your organization if there's too much of it for your tax exempt status. Gifts that would be inconsistent with law or with your organizing documents. Gifts where purpose restrictions could endanger your funding from other sources. These are all things that we've seen and things that are listed in the gift acceptance policy, really just to trigger the thought, as this is being screened, is there a problem that we need to address up front?
So it's also a good idea for the policy to list the sources of gifts. So gifts can, of course, come from the donor themselves, but donors may also arrange for gifts to come from other sources, such as by making recommendations to their donor advised fund, or if the donor has a family foundation, they might make a gift from their foundation. Also, of course, donors can make distributions from retirement plans, either naming the organization as a beneficiary, or if they're an older donor and required to take required minimum distributions, they can make qualified charitable distributions from their IRAs. And so the point of listing these is educational for the donors, to just remind them that these are other ways that you can support our organization and other types of gifts that you can make. And it can be a good idea to include in this section just some information about, you know, how these kind of gifts get acknowledged, or, you know, the fact that, you know, if somebody's taking a qualified charitable distribution and directing it to the charity, that, that comes from the retirement plan. They don't get a tax deduction for it because it's reducing their taxable income that they would have to take from their otherwise as a required minimum distribution.
Yeah, this also serves a good sort of board fundraising function as well. When your board is looking at the gift acceptance policy or looking at revisions of it a few years down the road, this gives, often development folks are looking for opportunities to get in front of their board to say, board, here are some things you guys should be thinking about giving as we're trying to get other donors to take advantage of these strategies. And that's an opportunity where they're a captive audience and have to be looking at this policy to educate them and fundraise to them as well as externally to donors.
Then it's also typical to include a list of the types of assets accepted, and accepting cash sort of goes without saying, but it never hurts to include it. And just also sometimes people put in the policy, how do you make gifts to us? So, of course we take cash, we take checks, credit card payments, wire transfers. I wouldn't put the wire transfer information in the policy itself, but for security purposes. But anyway, just to make people aware that here are the different ways you can get us your cash. And then, of course, publicly traded securities are another popular option. And you may want to include some language that states that those will generally be sold upon receipt, so the organization can lock in the value and isn't taking a risk of loss. For any of you whose organizations may not have taken stock donations before, there's a Mass Nonprofit article that we drafted last year that walks through some tips on that process. And then for tangible personal property, there are you want to specify about when you would take tangible personal property and when you might use that property in furtherance of your mission. I mean, you don't need to go into great detail here, but just to note that there's a difference between related and unrelated use items, and that the charitable deduction is different for donors who donate items that are used of appreciated property that are used in the course of the organization's charitable operations versus ones that are sold shortly after receipt. And there are special substantiation requirements for gifts of tangible personal property. Oops. Other types of complex assets you would want to list. I mean, these are just a few examples. You may want to list others, but cryptocurrency. So for example, you want to think about whether and how your organization would accept cryptocurrency, and in terms of how to accept it, whether it would do so directly or through donor advised fund or through a third-party payment processor, whether you would generally keep it or sell it upon receipt. And if the organization would keep it, that it's important that that be done consistently with your organization's investment policy. Also, you want to make sure that the organization has systems in place to record and report on cryptocurrency that are consistent with IRS and GAAP. And so some of those issues you may want to touch on in your policy. And then you might want to note life insurance, if you would accept donations in the form of being named as a beneficiary of a life insurance policy or other types of life insurance arrangements. And then real estate, you would just want to note whether you accept donations of real estate, and if so, what the process is for doing that, for analyzing, does this real estate, is it consistent with our mission? Can we use it in a way that won't be overly burdensome? And of course, you want to put donors on notice, or potential donors on notice, that you're going to go through a due diligence process that would, of course, involve, an environmental due diligence and title check and other types of due diligence with respect to any real estate that might be donated. And then Brad's example before illustrated the perils of accepting closely held securities. And so in some circumstances, it may make sense to accept securities that are not traded on the public market, but you do want to have a process to look into what restrictions are associated with them and other issues that could make the security not a not a wise acquisition by the organization.
Yeah, and in terms of the policy itself, the policies differ dramatically from one to another, partly in terms of how they address these things on this slide, partly as a function of how big the organization is and what kinds of gifts it typically takes in. So if you're a smaller organization and you don't have experience taking in some or all of these kinds of gifts, then generally the policy could be as simple as we will consider gifts like this, but only after review by this committee. And we'll discuss it on a case-by-case basis and not get into it further. If instead you're an organization that does have some experience with one or more of these things, then your policy might say, we will consider gifts of real estate, but here is what we need, and here are the people that need to sign off on those things. Or it could be like with real estate that you've got a separate set of procedures that's externally referenced for what to do if you want to keep your policy relatively lean in terms of its public-facing element. So let's talk a little bit about deferred gift arrangements. These are other things that are often referenced and discussed in policies, again, partly as an educational function, both internally and externally, partly as a fundraising function, and partly because some of these things have to be processed differently than others. Pledges, for example, especially if your organization focuses more on non-binding pledges rather than binding pledges, which I find to be the sort of growing industry standard. I think in the past, organizations have been more focused on legally binding pledges. I find that to be less the case now than it used to be, at least anecdotally from what I see. And where you're dealing with non-binding pledges, you don't necessarily, depending on your organization and the nature of the pledge, you need to bring a whole committee into things. A pledge is something that if you've got the forms for it and you're used to doing it, you might be able to allocate to particular development professionals, and here's our form, and if they want to use that form, fantastic. Or it might be that you don't have familiarity with these, and therefore you want a little more groupthink around it until you do. This is where the policy has to be customized based on who you are, who works there, how savvy they are with some of these things. Remainder interests in real property is something that should always, always, always be looked at by a committee of folks. We talk about as one of the possible ways in which people can give to charity while not affecting their current life and cash flow dramatically, giving a remainder interest in real property, which can be an effective gift, but it's a tricky one in that you're sort of signing on to a relationship with these folks whereby you've got to devote some resources to monitoring that they're not wasting the property while you wait for the remainder interest. And so that requires some cost benefit analysis and some review of who's going to be living there, what are the conditions of the leases, and et cetera. Irrevocable plan gifts, usually the policy will say, we love bequests, we accept bequest, but we strongly encourage people to work with us on the language of the bequest. That's both in your best interest and in the donor's best interest, because you don't want to have a bequest that comes in that you have to disclaim because you simply can't do what it is that they want, and the donors shouldn't want that either. And if you're involved in any of these sort of partial interest gifts, charitable remainder trust, charitable lead trust, charitable gift annuities, those generally are going to require more than just the lead person to get involved in. And some of those are easier than others. Charitable gift annuities, if you do those, once you're in the process of those, they're fairly straightforward. It's a one-page agreement, generally speaking. At the same time, there are regulatory requirements around these, and so you certainly want to have legal counsel involved, at least in the early stages. But something like a charitable remainder trust is a heavily legal document, and is always going to require certain people to touch at the organization before it goes out. So again, when we're working with an organization on their particular policy, we'll talk about, do you do these things? If not, then the policy will simply say, we may consider these things on a case-by-case basis, and we move on to something else. If you do, then we'll talk about, have you guys been doing charitable gift annuities for 20 years? All right, well, you probably don't need a whole committee to look at each and every one. But if you're moving into a new state, it needs to go to general counsel's office or to outside lawyer or something like that. depending on where you are and what sorts of things you're used to doing. Restricted gifts, this is one that again is always going to require some degree of groupthink and approach, because here you are agreeing to funds that you can only use in a particular way, and that could end up being a white elephant, or it could end up costing more money than you think, depending on the nature of those restrictions. So we usually include in the policy statements that by default set the expectation that funds are going to be unrestricted, except to the extent that they are restricted, especially if you're sharing that policy with donors, which is something, again, that I encourage, making it publicly available, at least some version of it. Then the donors are on notice that their gifts are unrestricted unless you follow a certain procedure to make it restricted. We'll include statements that any purpose restrictions have to be consistent with certain things, the mission of the organization, their priorities. We're not going to agree to something that's going to force us to take a different educational route if we're an educational organization than we would otherwise do. That sort of thing gets set there to set expectations on both sides of the transaction. We'll often put limits on when somebody can restrict a gift. So if you're making, and that depends on the organization, but if somebody's making a gift of less than $50,000, is it worth the candle to have to deal with a restricted fund and deal with the auditors and separately account for it and all these things? So often the policy will set a limit that we're not going to talk about restricted gifts below a certain amount. Above that, we'll look at it according to these policies. I usually include in the policies that I work on a requirement that any restricted gift be reduced to a formal grant agreement that outlines those, because you don't want any uncertainty around email chains and communications. What did they intend? What did they say? You want to codify that in a document that says that anything external to this document doesn't count. This is all that we're dealing with. And you want to have, as part of your process, training, both, again, internally and donor facing, that donors cannot have ongoing rights with respect to the property. You can set purpose restrictions up front, and you can have advisory privileges if it's a donor advised fund, but otherwise the donor has to step back and then let you use the funds in the way that they were restricted at the time of the gift. And that should be part of the vetting process, because donors often want to kind of come in and visit what you're doing with it and have input on what you're doing with it, have a veto right over the person that you hire for a particular program. Those are things that you need to resist, and the policy can help you resist those.
Also, one thing I might note, it's not necessarily for putting in the policy, which is dealing primarily with donor restrictions, but just to note in your fundraising efforts that if your organization goes out and fundraises for a specific purpose, so if you hold a gala dinner and it's to support your, if you're a human services organization, if it's to support your homelessness program or your shelter program, then that creates a restriction, and you're required to use those funds that you generated from that fundraiser for that purpose. But just to keep in mind, and not necessarily to include in the policy, which is mainly dealing with donor restrictions. So in the policy as well, you want to include some language that, to others sounds like boilerplate, but, we lawyers love it, around legal compliance. And really the important thing on this slide is making sure that donors are aware that they're responsible for getting the gifts valued where it's required for their tax returns. That's not the responsibility of the organization. So they're the ones that need to go out and get and pay the appraiser for that. And that they're responsible for the cost of legal fees for completion and for other professional fees, accounting fees, appraisal fees, and the like for the completion of the gift. And then it's just important for everybody to keep in mind that the organization shouldn't be giving legal, tax, or financial advice to its donors. Then it's important to consult with legal counsel. It's part of the board's fiduciary role. It helps the board demonstrate that it has exercised its due diligence and exercised its fiduciary responsibility to rely on professionals where needed. And so, this isn't going to be required in all circumstances, but certainly if you're talking about complex gifts or gift restrictions or gifts with potential conflicts of interest, that it's a good idea to consult with counsel. And then, as I mentioned, and as Brad has indicated, we often review gift acceptance policies before they're finalized. And then in terms of gift agreements, so it's a good idea for the policy to state that, these are examples of circumstances where we will require gift agreements. And then also to specify some of the key terms that should go into gift agreements. And then it's important to have a form of gift agreement that includes those same clauses that you have in your policy, as well as, other clauses that you didn't necessarily list in the policy. And so, I think we've talked about on the points on this slide where a gift agreement is important. So what to include in a gift agreement? It's important to make the agreement specify the sort of dominant charitable purpose of the gift, and frame other restrictions as more subservient or incidental, so that gives you ammunition if you're trying to have to go to court and get changes, or to even perhaps avoid going to court with a variance clause that Brad will talk about in more detail in a moment. We also like to have gift agreements refer to the organization's gift acceptance policy. And also, if your organization does issue naming rights, to specify in the gift acceptance policy, in the agreement, when there might be limits on naming rights. And then it's also critical to include in the agreement and in the policy describing what goes in an agreement, the fact that the organization has the right to allocate administrative costs to the gift, to the extent that they're reasonably attributable to the gift. Because if you don't have that in the gift agreement, then you're not going to be able to allocate those costs accordingly.
Yeah, let me underscore one of those, that first one, the express dominant charitable purpose. There's this tension in the law between interpreting a gift agreement as a gift with some restrictions on it, which by default is now in the charitable realm. The money must always stay in the charitable realm. And now the question is, can the charity use it for this or that or the other? And under the sort of pure old common law way of looking at this, only the Attorney General has standing to deal with the charity on that, not the donor, once the charitable gift is made. Or seeing the gift agreement as a contract, like especially when naming rights are involved, like FedEx is paying to have its name put on the Orange Bowl, the college football game. Is that the nature of this agreement? And depending on how you frame the agreement, in part, courts sometimes will look at it as a contract, in which case the breach could result in having to send all the money back, including interest, for whatever period of years, or looking at it as a charitable gift, but with some restrictions and conditions. And those restrictions and conditions are subservient to the charitable gifts, so that if those get frustrated, at least the money will stay in the charitable world, whether your organization keeps it or it goes to another charity or for another use. And it's helpful in the gift agreements to frame it that way, as really this is a charitable gift, and then here are some sort of subservient provisions, to put yourself in a better position, as Eleanor said, if it gets into a fight, that you're not going to have to give the money back, which is never something you really want to be doing. So let's talk more about the variance clause that Eleanor referenced. There's always a tension between donors in the organization in terms of what can the organization change down the road. Donors often want to say, you're going to use it for this, this, and this, and absolutely nothing else. And any changes require my express written consent. Organizations are often going to be around for hundreds of years, and over a period of time, things have to change. Money that was given for studying homeopathic medicine, you can't really, that's not as viable now for many organizations as it might have been 100 years ago. And so the organization needs to find a different use for the funds. If you don't have the legal right to do that as a function of the agreement between you and the donor, then you end out, if the donor's not around anymore, having to go to court to do that. The donor's surviving spouse and heirs don't have the authority to agree to those changes on behalf of the donor, and having to go to court can be expensive and time consuming and problematic. So it's advisable, to the extent that you can, to include in the gift agreements and in the gift acceptance policy a provision that allows you to make changes. Now, you have to calibrate that with your fundraising donor-facing functions. If you frame your variance clause, we're going to do off, but we can change it however we want, whenever we want, the donors are never going to agree to that, and you're going to create some bad blood between yourself and the donors. On the other hand, if it's not flexible enough, then you find yourself caught in a bind and having to pay folks like us to help you go to court to get things changed. So the balance that I like to strike is the language that we've included here, and I won't read it because we're short on time, but just to highlight it, the idea is a sort of what I call self-help cypre. Cypre is the legal principle by which you can go to court to get permission to change the use of charitable purposes, but you have to demonstrate, one, that using it for what was intended is impossible, impracticable, or wasteful, and two, that your proposed remedy is as close as possible to what the donor intended or would have intended while addressing the problem. And this variance language is sort of intended to allow you to do that without having to go to court, but it does hold you to some standards so that you can't just change it because we want to do something else. You have to make a reasonable decision that we can't do this the way that was intended, or it's going to cause us legal or ethical problems, or it's going to significantly undermine our mission or reputation. And you have to come up with a solution that is as close as possible while addressing those problematic things. And I've found this one to be a balancing point that often donors and organizations find is a comfortable one, but there's no necessarily right or wrong answer. Each institution has to decide what's the variance clause that we're going to use in our gift agreements, and then sort of navigate that with their donors. Let's talk just a little bit about naming rights. In the old days, the standard was, whether you're putting a name on a building or in a room or for a program, that I'm giving you money and my name will be on this in perpetuity. And the very much the standard has shifted away from that for a number of reasons. One, because perpetuity is a really, really long time, and that inhibits the organization's ability to raise funds in the future if there aren't opportunities for naming things coming up periodically. So often policies will say we will offer naming rights, but it's going to be time limited, either 50 years or for the useful life of the building, or for the life of this program, but we're not promising the program's going to continue. And sometimes gift agreements will have particular provisions about what happens if the building burns down or if you move. But in a policy statement, you'll set some standards that at least start the discussion at that point. We also have to address these days morality clauses. Some prominent situations involving things like the Sackler family, Jeffrey Epstein, Bill Cosby. These have all been ones that have come up in recent years that have forced people to reevaluate their naming rights because they've had difficulty taking names off of things where they had agreements that said it's in perpetuity with no conditions. And so now we try to weave these conditions into the agreement itself. And again, there's a balancing act there. If you say we can take the name off anytime we want, they're not going to make the gift. On the other hand, if you don't give yourself enough flexibility, you could be stuck with a name that's damaging your reputation. So I tend to use language that's very similar to the variance language from the previous slide, which is that we can take it off if we make a reasonable determination that it's inconsistent with the law or significantly undermines our charitable mission, and we'll try to find some other way to honor you that doesn't mean your name's stuck up there. But it's a touchy point, and it's one that's going to require some board conversation, because many of the board members are also key donors and may have particular thoughts about that language, and among all the constituents of the organization. But it does need to be addressed in the gift acceptance policy. And finally, a policy is only as good as your consistent implementation of it. The more you make exceptions, the less useful the policy is. On the other hand, there are situations in which you may want to make exceptions to the policy. And so you'll generally want to address in the policy who's going to decide to make an exception. That's generally going to be at a higher level than the people that are, implementing the policy. And if it's a significant material thing that might affect the reputation or the mission of the organization, then it may need to go to the board. And how often you're going to review the policy and update it in the context of whether you make exceptions and how frequently you make exceptions. And that's it. We have 3 minutes left for questions if anybody has any.
And we know we threw a lot of information at you, and you may think about some of the things that we said today, or you may look at the slides when you get them and think of some issues that your organization has experienced or questions that you may have about your existing gift acceptance policy. So do feel free to reach out if you don't think of any questions right now, but think of questions after the fact. So we thank you very much for joining us today, and do stay tuned for future M&N webinars, and we hope to meet you out and about at a M&N conference or elsewhere throughout the Commonwealth. So thank you for joining us.
Thank you, everyone. Good day.